A very good evening, ladies and gentlemen, and welcome to Steel Mint Engage. Engage is a 5-day webinar series being held from October 18th till the 22nd. We will be holding 16 sessions covering 6 industry verticals, including iron ore, coal, scrap, and steel. Through more than 700 minutes of knowledge sharing, we will understand the perspectives of industry leaders and enable our clients to have a better understanding on how each sector is likely to pan out in the short term. I'm Madhumita Mukherjee, editor Steel Mint, your host for the evening. I would also like to take this opportunity to thank our esteemed sponsors for the event, NMDC, Tata Steel, and Runta Steel. The topic we will discuss today is when do we expect the vessel freight market to normalize? It is an extremely relevant subject against the backdrop of the present volatile dry bulk cargo segment. In our earlier sessions, some of our guests stressed that logistical challenge is the biggest challenge today affecting commodity trading worldwide, pushing up prices. Congestion at ports due to COVID protocols and longer vessel turnaround time, power outages at Chinese ports, weather disruptions, against the backdrop of robust demand have all resulted in an acute supply-demand imbalance. How will things pan out in the short term or even the medium term? We will learn a lot more as we move ahead in the session. I have with me today our esteemed guest and speaker, Mr. Sanjeev Bhargava, CEO, Bulk Marine. Bulk Marine, with offices in Hong Kong, Singapore, and India, is one of the oldest established ship operating companies servicing Indian steel, power, and cement industries since 2003. Mr. Bhargava has an extensive experience in servicing the freight requirements of the steel, power, and cement sectors. He has been present in the Indian commodities market since 1994. I also remind our viewers to send in the queries, which we will take after our discussion is over. But now over to you, Mr. Bhargava. Please carry on.
Thank you, Madhumita. Good afternoon, good evening, good morning to wherever you guys are. Before we start, I'm thankful to Steelman for asking me to do some crystal ball gazing on the markets. But prior to that, I would like to go back to how it all started, So basically, transport rates have actually spiraled out of control, and the obvious reason being the COVID-19. However, if you look at pre-COVID-19, the market was very sluggish. The economic activity, the industrial production was down. The freight market was pretty much at a very low level, So, and then came the COVID-19. Essentially, the whole market sort of withdrew for a couple of months. And to people, it was like an end of the world. However, what happened subsequently is what makes the market so interesting. The demand went down, the orders were withdrawn, and people basically took refuge. While they took refuge at home, things just went from bad to worse, for the freight market. However, the government stimuluses then came along and it spurred the activity, which took market by surprise, in fact, So people, instead of spending money on their clothes or foods, etc., they were spending the money on the stimulus money and the savings on upgrading their houses, the other things that came along with working from home. So that's where the demand came in, and suddenly, people start scrambling, heading towards the supermarkets, and the shelves were empty. And then suddenly, all the people who had stopped processing or manufacturing suddenly came alive, and this pent-up demand started unwinding, which led to initially in the container market, as we must have seen, and subsequently it picked up went into the dry bulk market. That's how this whole situation came about. So I'll try and make an attempt to crystal gaze. What do we expect? When do we expect the freight market to normalize? So here is the agenda, which basically covers economy, global economy and trade, demand and supply outlook, together with geopolitical risk and operational inefficiency, and how regulations are going to affect the future of the shipping. So getting back onto the slide, which is very interesting, the global GDP, if you notice, the IMFO has projected a growth of 5.9% in 2021 and 4.9% in 2022. Beyond 2022, the global growth demand is projected to be moderate, about 3.3%, as the pent-up demand unfolds from the COVID-19. Hopefully it does, and this COVID situation is, by then we see the back of it, So this is how the global demand growth is going to pent up. And GDP, normally the shipping demand keeps in line with the world, global seaborne demand keeps in line with the global GDP. So here we see the GDP pretty much peaks off on 2021 and then starts slowing down to 2023. We'll get back to this reason why this is happening. So the major demand drivers is China manufacturing PMI. As you see, the PMI is looking pretty much flat going forward. Well, primarily, as you realize that China has clamped down on tech sector, and now the property market is hurt because of Evergrande fiasco. So we see the property market cooling off. As such, we see the demand outlook for iron ore and construction material will probably come off, and that will also affect the infrastructure story in China. And which pretty much was in line with yesterday's GDP that came out of China, which showed the growth is slowing down there. Obviously, because of these tightening measures on the technology sector and on the property market, and it's seeping into other segments as well under the Common Prosperity Program. So we see going forward that will possibly affect the demand. And China is probably the largest importer of materials. It's pretty much about 50 to 60% of the global seaborne. So whatever happens in China will affect the demand for shipping going forward. Of course, the two biggest indicators are iron ore and the global steel production, as far as the demand drivers is concerned. And when it comes to steel, we are talking about material like iron ore and coking coal and thermal coal, per se. Now, the question is, if there is a slowdown in China steel industry, what will happen to the steel production? So what we see is there's going to be a fair amount of growth on the steel side from different countries other than China. But one of the main concerns perhaps will be, if China is unable to utilize the steel in their domestic industry, then we probably see then there will be a big emphasis on export of steel to the rest of the world. That may create some protectionism into other countries, and that will probably give rise to another World Trade Organization disputes and other things. So that is a big if on that, but sorry. So moving on to the next slide. Is that the right slide? 1 second. Okay, so the two commodities which probably we will see in terms of growth will slow down is the iron ore and the coal commodities. As you know, because of the environmental requirements, coal is pretty much, seaborne coal will pretty much peak in a couple of years, because of the green requirements. So apart from India and China, we'll see the rest of the world, the coal consumption will drastically reduce going forward. In fact, if you look at it, Europe was already down, but I'll come back to that story a little later on the slides. Iron ore demand, iron ore will eventually peak because not at the same level as coal, but you'll see the iron ore demand flattening out maybe by 2030. Okay, besides iron ore, coal, we see a big demand for grain and minor bulk this particular year. The reason being, of course, grain was one of the main drivers of the freight this year, essentially because China had a record import of soybean and grains, which we'll follow up a little later on. Minor bulk story is very interesting because minor bulk essentially looks very promising going forward with the growth rate of 4.8%. The reason being, there are a couple of major reasons for that. One of the things, a lot of container cargoes have spilled over into the break bulk side, which is giving that impetus to this growth in handy-size market, And also other commodities are being shipped into smaller size vessels. The reason being, the commodity prices are going up, and smaller players like to import in a smaller size because of the cash flow requirements. So the smaller players will tend to ship in smaller ships rather than on a bigger ships. So that is one of the reasons why minor bulks have taken a big, probably they're one of the best performing markets this year. Okay, going on to the dry bulk forecast trade, we see this particular quarter is a very seasonal, the best quarter for the shipping, primarily because iron ore and coal side, China tends to increase their buying and increase their stock holdings for winter, and this tendency continue until just before Chinese New Year. Of course, we see right now the coal under the energy crisis is basically going to come out with a different story altogether. So it's not seasonal. It's more the crisis that's driving the coal demand right now. So coal is probably about 400% gone up in prices since the beginning of the year. And that is primarily because of the energy crisis in China, India, and Europe. And that probably stems from, of course, China was caught unaware of their inventories, and there was a problem between Australia and China on the coal import side. So there is an increase in ton per mile because China is going out from the usual markets in Asia, and they're trying to go towards Colombia, South Africa, and United States to buy that additional coal, which basically is coming out of from not purchasing the same from Australia. And of course, the major beneficiary of this coal is Indonesia right now, we see. So Indonesian coal is in big demand. Grain, once again, we see a record shipment this year on soybean. And more interestingly, I think one of the main things that featured this year was China. On the grain side, the Chinese grain imports have gone up about almost 180% from year on year, from last year. And in fact, corn used to be one of the exports commodity in China, and this year they're buying record corn. There is a record corn imports, So that is essentially the reason why the grain imports and the markets of Panamax is doing so well. Going back onto the minor bulk commodities, this trend will continue. As I said, it's one of the best performing market this year in terms of stable earnings. And this probably will continue as we see. Okay, as from this particular graph, you can see that pretty much minor bulk is back from post pre-COVID levels now. So we are back into that scenario now. So, and that's why the reason why I said it's looking very promising. We'll go down. Okay, all of us are aware of the geopolitical reasons why this price rise is going on and why the commodity markets are so strong. So we go back to US, the major being US-China tension and followed by China-Australia problems. These are the major reasons, geopolitical reasons, which are driving up the commodities market, apart from the pent-up demand that is coming out of COVID-19. Now, further down, as we say, as there is a slowdown in China imports, we probably might see if China starts exporting instead of if their domestic market starts slowing down, we'll probably see a return of protectionism. I mean, it's already there. Like if you see Atmanirbhar in India, it's nothing but a form of protectionism. Of course, we also see sort of a trade war between Europe and Russia on the gas supply, which I understand now it's being settled. Russians have basically agreed to supply more gas to European market, apart from the contractual quantities they have. And that is primarily the reason for energy crisis, actually, because Europe has suddenly run short of gas for the winter, and there is a panic among Europeans, and there is a scramble to buy fuel. So that is perhaps one of the reasons why we see the gas prices have gone up high, and followed by the oil prices. And now eventually what is happening is that is seeping into the coal. Now, if coal was one of the commodities which was probably in Europe, we thought that that is, but this is a one-time story. I see the coal will continue to be less used in Europe because of the ESG requirement, environmental requirements. But I won't say the same for India and China and Asia, because Asia is perhaps 80% of the energy source comes from the coal, and I do not see that next 10 or 20 years, China and India will be gathering momentum on the ESG at the same pace as like European Union and United States of America. Okay, so we move on to the next. Okay, we come back to the energy crisis. As I was telling you earlier on, the coal prices have moved almost 400% since pretty much last year at this time. Almost 500% actually. And this has really happened because of the LNG prices. LNG prices were the accelerator for the energy crisis. And now what has happened, I mean, this is only today when I was reading that Russia has agreed to supply more LNG. China has started producing more coal. So for the first time, we see the prices are moved down a bit this side of the week. I don't have exact prices, but it seems we probably must have seen the peak of coal prices this side of the year. And as you can see, we have a very low inventory in India and China. China, I think, is currently at about 9 days, and India went down up to 3 days, I think. Now this, okay, one of the things which I think I should, on this right-hand corner, there is a graph which basically is telling us in 2020, the long-haul coal imports was around 10% and 90% was within Asia. coal movement. But this year, because of the shortage and crisis in Europe, the long hauls and the China importing from US and Colombia and Richards Bay, the long haul, the ton per mile has increased, and long haul business about 30%. And because Australia is not in the play, the short haul has moved down from 90 to 70%. Okay, we all know the story about the renewable, the future belongs to renewables, but currently, as I said, about 80% of the power generation in Asia is a coal story. But I think the first country first area that'll probably come out better on the renewables usage is Europe, and followed by US. And these are the two countries which probably will lead in the renewables. As I had mentioned earlier, I don't see Asia picking up momentum on ESG reforms soon. And primarily the reason being why they won't do it is because industrial sort of a revolution in Asia just started, let's say, around mid-80s or 1990. And the capital investment in power generation, coal-fired power generation, is relatively young. So I do not see that anytime they will be in a hurry to dismantle. And moreover, to switch to renewables, it requires a lot of capital investment, although the cost is coming down. So at some point of time, I mean, the cost of generation of power on coal and renewables is almost same at the moment. But the switchover, the change of switchover is not as good as it is in European Union and US. And as I said, like, they don't see any particular reason to do their capital expenditure when they already have the coal generation. And they'll probably try and stretch it until the last minute, when you have certain deadlines, when you switched, when these countries are committed to net zero emissions. So I think Asia will be the last to move on to that bandwagon. These are the costs of generating electricity. As you see, these renewables are almost pretty much coming closer to the fossil fuels range. So, of course, this is not the part of this requirement. So I'll just skip this quickly. One of the interesting trade that is gathering momentum is spodium. It's a derivative of silicon dioxide, which basically produces lithium. And lithium, as you know, has been big demand for batteries. So that trade is picking up a lot of momentum. And right now it's between Australia and the two lanes are Australia and South America. And these are all the requirements for anybody who's interested in producing batteries, lithium batteries. As you see, this growth is about approximately 40% per annum on this trade. So this is one of the new trades which I'm not sure that many people are aware of. That's why I just decided to include this slide into it. Okay, one of the main reasons for escalating freights this year has been the operational inefficiency, which primarily means congestion. And congestion is much more in the Chinese port. Earlier, it started with South American grain imports. Then there was some congestion in Australia. However, because of COVID-19, the Chinese government implemented 28 days waiting time. And essentially, on the dry bulk side, the congestion grew even bigger because of Chinese government trying to give preference to container cargoes over the dry bulk cargoes. So at any one given time, actually, there was about 5 to 6% of global fleet was stuck in congestion, which is almost equivalent to the new buildings, which is supposed to come out this year. So that was perhaps one of the major reasons why the freight rates went up so much. And also the other thing that has happened is the average speed, as you can see, is gone up primarily because people are paying so much on a daily hire that they want to finish their voyage faster than, and obviously with the expensive oil prices, they wanted to complete their voyages as early as possible and get the vessel for the next employment because of the congestion. Inactivity is basically when ships are lying in ports stuck in congestion. That basically amounts to congestion. One of the things which you must have seen is this inactivity lasted for too long, from last year, June 22 up to now, because of the reason being a lot of Australian imported coal was stuck in China. There were about 70 to 80 ships which were waiting in China to be discharged, and which actually never discharged. And this was almost about 6 to 8 months. Finally, the government allowed those coal cargoes to be moved out of China. So the Australian coal from China was being imported into India. That was one of the major destinations. So now you see that inactivity is decreasing. Okay, one of the more important things which people should be aware of, especially on the buyer side, which is very important for people who are not in shipping to understand why the shipping freights will not come down in the near future. And this is primarily the reason is under IMO rules and regulations, vessels are supposed to reduce their carbon emission to 40% by 2030 from the existing 2008 levels. And by 2050, IMO targets the reduction up to down to 70%. So in other words, it doesn't look like that shipping will be completely free of carbon. Now, there are two very important rules which will come into play by 2023, but at the moment everybody is very quiet about it. Those are energy efficiency existing ship index, XC we normally call it, and the other one is carbon intensity indicator. So XC is a framework for determining the energy efficiency of the existing vessels over 400 gross tonnage. And carbon intensity indicator is all the managers who are controlling the ships, they must have a way to determine ships' carbon intensity profile, and they should develop an optimized ship energy efficiency plan, to demonstrate how they will reduce the carbon emission. So the carbon emission control can be controlled by, will basically change the landscape of the current marine fuel which is being currently used on the ship. Just for record, every 1 ton of fuel presently which is burnt on ships today, it produces 3 tons of carbon dioxide. So now industry is really researching and debating on these future fuels, which is like essentially ethanol, then methanol, then hydrogen, ammonia. So currently what is happening is it's all under debate. There is a lack of visibility on the future fuel beyond 2030. As you said, that by 2030, they have to reduce the carbon footprint by 40%, the emissions by 40%. So now, essentially, what is happening now is, because of the absence of the future fuel, the owners are not willing to order any new ships, because they don't know after 2030 what will be the technology, engine, and fuel that will be used going forward. Now, an average age of new building ship is about 20 to 22 years old. So what happens next is, if in 2021 I order a new building, under the present circumstances and under the present design and fuel available, I have to take that risk whether my ship will be tradable after 2030, or do I have to dismantle my ship? Or dismantle means, do I have to demolish my ship because she will not be tradable under the new rules and regulation. So in the absence of any particular availability of the future fuel, there is and the ship's design and engines. Right now, the new building is pretty much on hold. Nobody wants to order new ship because of the reasons I told you, that by 2030, these ships will not be tradable under the new rules and regulation. So as a result, the fleet growth is very, very low right now, especially these last 2 years. And also one has to understand that if you start ordering a ship now, it will take a minimum 2 years, to get a new delivery. So this is basically the reason we see the supply side is going to continue to be in a problem for the demand. So the supply will not be able to cope up with the demand. Basically, that's the story. Then going forward, energy efficiency existing ships will all be classified in a grade from A to E or A to F, I think, F, sorry. And it's A being the best energy efficient ship, and F is probably the worst. So in 2 years' time, when this rule comes into play, the ships which are classified under D, E, and F categories will eventually have to go to the demolition side. If not demolition side, they will be used on coastal service like India and China, where the emission controls is a less stringent requirement than the global side. So that eventually will come out from the international trade, what I mean to say. Now, carbon intensity, of course, is an indicator. You have to, how do you achieve a low carbon intensity? You can do it by slow steaming. You can change your engine design. You can switch the fuel, or you can have essentially a hybrid fuel. But the problem is there is no engine design at the moment, and we do not have any future fuel. So the only option which you right now have is either you slow steam the ships to reduce your carbon footprint, or you use a transient fuel, LNG. There are some ships which are using methanol going forward. Some owners have managed to order that. So that probably is the trend right now, to switch to methanol. See, the reason being, it's not easy for future fuel to be decided, because it will require a big infrastructure spending on the distribution of that fuel. So first, the fuel has to be adopted. Then you have to ensure that there is a proper distribution for ship to be able to bunker everywhere in the world. So this will probably take some time. So in the meantime, what we see is the ship supply will always be a problem for next couple of years until we figure out a way of the future fuel and the engine design. This is a graph showing the future fuel by 2050. Okay, we come more to the interesting part on the fleet growth. So the fleet growth, the compound annual growth was from 2015 to 2020 was about 3.3%. And as we are seeing that, as we were talking about it on the last couple of slides, the supply side is slowing down. And as I said, there is no future. We don't see that there is going to be any immediate. See, if you really want to look at it, in this kind of scenario, when the freights arise, all the ship owner would have been rushing and ordered the new buildings. But what is preventing? I've given you the reason why it's not happening right now, because of the absence of there's no visibility on the future fuel. So right now, what is happening in the market? The second-hand markets are trading right now. Basically, ships which are 10 to 12 years old are in high demand because everybody wants to take advantage of the current freight market. And now, it suits 10 to 12 years because by 2030, all these ships will be reaching a demolition age. So at that time, there will be by 2028, 29, you'll see the demolition activity will start moving up again. And also in 2 years' time, when the new XC rules comes into play in 2023, 2024, we'll see an increased activity in demolition, which again will create a supply bottleneck. So that's again an indication that there is no easy way out, that freight market is going to come down anytime sooner. See, at the bottom graphs are giving you some idea of what the dry bulk deliveries are. And the demolition, you see the demolition, I was telling you, it's going to peak in 2024, and the next one will come around when at 28, 29, 2028, 29, when the IMO rules kick in 2030. And you can see that there is hardly any increase growth in the supply in the new building deliveries up to 2026. And there's one more interesting aspect where people should look at it. Right now, the container industry is doing extremely well. They probably have never made so much of money in the last 40, 50 years since the last cycle. So perhaps the first people who will go into new building orders will be the container ship owners. Interestingly, yesterday I was reading Walmart, IKEA, Amazon. They have declared that by 2040, they will want to get onto net zero shipping supply chain. Now, as I was telling you earlier, there is no way shipping is going to be net zero until probably perhaps 2060 or 2070. So what will come into play big time is the carbon emission trading. And that is perhaps one of the going forward, that will be one of the simultaneously people will be trading carbon emissions while they are selling and buying commodities, and using shipping. So that will probably one major thing that will happen for next 10, 15 years, carbon emission trading, carbon trading. And the other thing which I expect out of this is the shipping market, and the way shipping market probably is trading, it might move from spot to long term, because let's take, for example, miners like Rio Tinto, BHP. They are already looking at a long-term supply of net zero shipping. So that is basically a motivation for ship owner to order a new building if we can get a long-term contract with these people. Because obviously, when you're heading to changing your technology and changing the fuel, these ships are going to cost substantially higher than the new buildings under the present ship design and fuel. So anybody who's ordering these new buildings will expect a certain return, minimum return, before he dives into it. And obviously that will come from long-term contracts with the people who are, with the companies who are right now very conscious of their ESG standing. So I see this probably will move the new building market going forward, with the longer term contracts from these companies. Incidentally, markets like India are very spot oriented. even China. And of course, interestingly, Chinese government has now told their coal buyers to go out and conclude long-term purchases. This has probably happened for the first time I know in last 30 years. So if they adhere to it, commodity market will be pretty much stabilized with if Chinese buy on long term. I mean, the whole idea of buying long term is they want a stability of price and stability of supply. The fleet profile is fairly young in all sectors. We see very little, except for Handysize, which is about 15% beyond 20 years. We see there is a fairly young Supramax, Panamax, and Capesize fleet. So apart from the ships which will get demolished from XC and the carbon intensity indicator, we see there is, as I was telling you earlier, there's a lot of sale and purchase activity under the present supply of tonnage. This slide is basically about new building and new orders, about the order book. And apart from 20 and 21, there is not much beyond going forward. The fleet growth is very little. As you can see from the next graph, order building is showing down to about 7-8% by 21. So from 16%, it's coming down to 8%. So which is basically indicating there is a lack of supply, going to be lack of supply. So you see the order book in 2022 is probably the highest, and then it starts going down drastically. That's the order book profile by ship, which is self-explanatory. Okay, coming back, as we were seeing, Handysize is probably one of the better performing segment of the market, and it will continue to stay so. Supramax are doing well. The only segment which is very volatile is the Capesize segment, and the reason for that is because it's only carrying one major cargo, that's iron ore, and to a certain extent coal. Now, what is happening there is, if China changed the policy on buying iron ore or stocking their iron ore inventory, it suddenly affects the Capesize volatility because they don't have anywhere else to go. Panamax can load iron ore, can load coal, it can load grains. Supramax and Handysize can virtually do everything what Panamax is doing. Handysize is taking the load of the container industry. So basically, we see these markets will be more firm going forward. We've already seen a big correction on the Capesize recently last week, primarily because of the Chinese policy and the problems associated with the Evergrande and the effects it's having on the property market in China. Charter rate forecast, the dry bulk demand eventually will start going down, as we said on the first slide on the IMF forecast. The reason being, the pent-up demand is going to gradually come back. And one of the ways to actually determine, a simple way to determine what will happen to the demand is when we start going back to our old ways, pre-COVID levels, then the demand will stabilize and things will start getting back to normal. But the supply chain disruption is probably not going to go away in a year or two. So we see the market, at least for next 2-3 years, is remaining firm. As you can see from our forecast down there, the market is looking very firm going forward, 22, 23, for the reasons I told you. The regulatory requirements are also pushing the freight rates to go up because the replacement tonnage is not there yet. Okay, so we come back to summarize. We see right now the freight market is pretty much driven by the energy crisis, and coal might keep the freight rates high. Uh, we are not sure what will happen to the iron ore market because if China continues to slow down, at least over for next 6 months, we see there will be a lot of volatility on the Cape size, but we continue to believe that the freights and other segment like Handysize, Panamax and Supramax will continue to remain firm. And this situation will probably get worse because of the new rules and regulation that kicks into 22, 23, which I do not believe world is paying any attention to. I mean, especially the end users. So, and long term, of course, there are a lot of opportunities because of IMO rules and regulations. People who will, the shipping by then would have made a lot of money, especially the container and bulk shipments, bulk segment. So they should have adequate capital to invest in new technology and new fuel. And we perhaps, as soon as a new fuel is determined, which will carry which will carry them through 2015, I would expect there will be a huge orders for new buildings going forward. So in short, I do not see there is any reprieve for freights coming down anytime soon here. Thank you.
Thank you, Mr. Bhargava, for such an enlightening presentation. Very detailed, very broad-based, and it touched upon almost every segment that I would have questioned you on, actually. You've answered most of my questions even before I could ask them. But still, we were discussing before we began the webinar, actually, that the biggest challenge is not the logistical challenge. If you would like to share with our viewers why you feel so.
Oh, in the logistics, there is a challenge in logistics. Of course, there is a problem with congestion, the commodities not reaching on time. But I do not believe the freight rates. Yes. Freight rates are not freight rates, in my opinion, today. If you look at the growth in commodity prices over the last 1 year, freight has really not moved in the same tandem as commodity price. In fact, in some commodities, I feel freight is cheaper. If you look at the freight component on CNF value, today, Australian coking coal probably is 10% of the commodity pricing. And if you compare this about 6 months ago when the market was low, I would say the freight component was about 20%. So in a bigger scheme of things, it's not really, iron ore and coal segments because the freight hasn't really moved up that much. Yes, in quantum, it has gone up. But if you look at the comparison of the ratio between the commodity price and freight, it hasn't gone. But at the same time, yes, if you compare a cargo of limestone or aggregate, the freight has gone up by 300%, because the commodity value is $6, $7 for that freight, commodity, whereas the freight is around $25. So that portion has, of course, gone 300% in some cases. I hope that answers your question.
Yes, thank you. There is no doubt that there is a commodity bull run at present. Also, buyers are diversifying origins of their iron ore and coal cargoes. So is all this also responsible for the high freight rates, or is it vice versa?
No, it is because of the diversification. It's precisely the reason why the freights are going up, because of the diversification, we are spreading out, which are stuck in congestion. And what used to be a smaller market for these trades has suddenly opened up on a bigger route. So your ton per mile is increasing, and that's
Right.
essentially increases the freight cost.
Right. And I know you did touch upon this, but still, I would like to hear from especially coal and iron ore aspects. Like, is there a scramble for larger Cape-size vessels? And if you could elaborate on this. And also, do Cape-size freights set the rates for other vessels too, since the per ton cost would be larger, would be less
do
for a
not,
large.
no, I do not believe that Cape size sets the market. Because Cape size in itself, as we discussed this earlier, it's a very volatile market. And it's pretty much 70% of it is controlled by the Chinese imports. So any effect on Chinese policy basically can push up or push down the market very quickly. Whereas in other segments, you'll never find that kind of volatility. So, and when it comes to India, India is hardly very little imports on Cape size. In fact, we have only very few ports which are taking in Cape size ships. And see, the problem also stems that, like, unlike China, India, when private companies buy, there is a big problem with the liquidity in today's market. Banks are not are unwilling to provide letter of credits to traders. So those loan facilities are not there, unlike in China. So what is happening? We already see there is a lack of activity in India. Let's say Indonesia to India, because the commodity has gone up by 400%. What we are seeing is the smaller traders are not in the market. You only see the bigger, more established traders or buyers in the market. So the other smaller traders are cut out of the market because of their inability to come up with such a large cash flow to buy one shipment. Now, as I said, like, the commodity itself has gone up by 500%. So what they could buy 5 shipments last year at that particular price, they can buy only one shipment today. Right. And for them, it's a bit risky to buy such a big shipment, because they're competing with the bigger players.
Right. Mr. Bhargava, Q4 is supposed to be the strongest demand period for vessels, and this is also strong demand season for steel. Also from January, export allocations will open for geographies like China, Europe. So how do you see freight rates behaving in calendar Q4 and Q1 of 2022?
The traditional Q4 is basically the strongest freight market, and we can see this. I do not see that this market is going to come off anytime, except for Cape. Cape will be very volatile because, as we said, like, Chinese are taking measures to. Now, one thing which I really forgot to mention in all this is, because of the energy crisis, a lot of manufacturing is going to get hurt in China, because obviously they have cut down on the power usage to manufacturing. Even in India, as you can see, the coal is being channeled for the end user for the power generation for the people. Like, right now, it's being diverted from cement companies or from industrial users to actually the retail side. Same in China. China has stopped. They have given instructions that come, especially, let's say, aluminum industry is perhaps one of the biggest guzzler of power. So they've basically asked the aluminum industry to shut down. And ports, in some cases, have been asked to operate two ships rather than 3 ships to save power. So this is creating a lot of demand for coal.
Right. We have a question from. Oh, sorry, please continue.
No, it's okay. Yeah.
We have a question from one of our viewers. With rising coal, coking and non-coking coal prices, what is your visibility on Indian mills booking cargo from Australia, Indonesia, and South Africa?
See, at the moment, Okay, I understand that because of the rains, suddenly the power surge, which was going on last week, which was about 6 gigawatt, has come down to two gigawatts. So basically, that what it says is, I don't think at current prices, Indian buyers will import coal. If the weather remains, it gets colder, I think in India, obviously we don't need heating at homes during winter, save for some part in the north. So the consumption of electricity will go down. Now we already see, because of the measures in gas market and coal market, coal prices are coming down. So what I've seen, there is a tendency for Indian buyers to stay on sidelines when Chinese are buying, because Chinese end up paying more money. So they wait for Chinese to get out of the market before they start buying. So that's one of my observations. So I do not see that India will be importing. And there is another conflicting message, because the Ministry of Power says we have enough coal. And the stockpile says another story. So
Yeah, actually, you answered one of my questions. Thank you. I have another question. Do you think Indian mills are deferring coking coal shipments
no, I
to
don't
offset?
think so. No, I think the coking coal is on the, because the coking coal, again, the prices have gone very sharply. And so, but we see a very promising Indian steel sector going forward. It's growing pretty, so I don't see that particular trade is actually on pretty, we see that is probably the only trade that is going on normally. Because also there they don't have to compete with Chinese, because Chinese are not buying Australian coking coal.
Right. So overall, do you see, I mean, especially for November, December, coal imports to India coming down? Thermal coal. No.
Yeah, thermal coal will
Thermal.
probably come down, because what I see is Chinese have already started buying forward cargoes. So for an Indian buyer who gets into the market and wants a spot cargo, either he will have to pay, first of all, he will have a problem getting a stem. And secondly, if he manages to get a stem, he will end up paying $10 probably more, because somebody has to give him a stock from a Chinese buyer. So unless he sees a little better prices, he will not sell to India, unless he already has a pre-purchased coal. So somebody going into the market right now, it's not easy to buy coal, on spot, unless you pay a premium over Chinese coal.
Right. So what is the news coming out of China in terms of its quarantine protocols? What if a situation arises where, quarantine, the COVID protocols ease? Will freights come down?
As I see there, yes, I mean, see, the important thing, what I see going forward is, because of this energy crisis, there will be an ease of congestion. Because if factories are not manufacturing, you see the PMI graph, which we were talking about in the first, the PMI actually is going down, which is, and secondly, you see the GDP China growth of China is down yesterday or day before yesterday's news. So that basically hints that the imports will be less, manufacturing activity will be less. So they will start, what I would read from this message is the congestion should start easing. And already, as we said, like China had started, had given instructions to the coal shipments which were stuck in from Australia. They were rerouted by traders to India and some other parts. So this is helping to ease the congestion. And obviously, I see the Capesize market has gone down, which is one of the indication that probably Chinese are not going to stock on iron ore.
Right. Interesting. And so, what about the supply scenario? I mean, ship supply, vessel supply scenario. You said that is going to be pretty tight.
It's going to be a problem. I mean, as far as my crystal ball says, the market is not going to be easy for next 2-3 years.
No, and will it impact freight rates?
No, it will. I mean,
To
obviously.
what extent? Yeah, to what extent?
I feel if, in next 23, it go worse because of the new regulation, basically. It's the regulatory requirements, one thing which is affecting the supply. Second is, of course, there is the new order building is very low, so there is no replacement tonnage. And third, even if the demand after COVID starts contracting a little bit, that demand is sufficient to keep the freight rates high.
I mean, it can't be quantified at this juncture. I mean, what the scenario is going to be like in terms.
I mean, if you ask me how much will be a K, I'm not able to answer that.
Okay, thank you so much. Do we have another question from? No, I think this question has been answered. Fine.
All right. Thank you very much.
We have to draw the webinar to a close. Thank you so much, Mr. Bhargava, for giving us your valuable time. That's all for the evening. Thank you, Mr. Bhargava, viewers, everyone.